Hooty hoo, all my stock market gamblers. Welcome today. I'm Tall Mike. It's Wednesday. We got a rally going on in the stock market. Dow Jones is already up 600 points. Now, what did I do today? Well, today I've started taking off any long positions I have, and I'm getting ready to put on my short positions. Now, why do I want to put on my short positions? Well, we're coming up to the 200-day on the S&P. Now, I think that 200-day, I don't think we're going to get through it. I just don't. I think we're going to come back and retest the lows, maybe even break a little bit lower. Now, I do think that'll be a buying opportunity. I think if we get below 4,000 on the S&P, that's a good opportunity to buy, because I do think we're still going to have a run up and make new highs. It's going to be with the printing of money. It's going to be increasing the debt. That's going to get us that run up. But right, today's a good time to take some stuff off. I think we're up 600 points. And I've took some stuff off, and I'm starting to put a few short positions on it. I got a couple puts on in the NASDAQ and in the QQQs, and I'm looking at also shorting the S&P. Okay, that's what I want to talk about in the stock market. Let's move on to the real estate market. Now, in the real estate market, what's happening? Well, we got interest rates going up, right? Okay, so interest rates in the last 60 days, basically on the mortgages, it's gone from almost 3% up to 4%. Now, what's this doing? Well, it's causing the mortgage industry to kind of collapse. They're having a few problems. Now, why are they having the problems? Well, mortgage industries, they make money by how many loans they can do. And right now, they're not doing a lot of loans. There's no refis. The refi business, it's like free money to mortgage brokers. I know a lot of mortgage brokers, being in the real estate business. I've been in it a long time. And when the refis are happening, the mortgage brokers, I mean, they just being a regular mortgage agent, you can make $1 million just on refis, because it's like free money to the homeowner. The homeowners, the rates went from 4% down to 3%. You call up all your past clients and you say, hey, would you like to refinance? It's not going to cost you anything, and your payment's going to go down. It's like free money. We can even give you money back, money out of the house. Your house is the ATM. But well, now we went from 3% to 4%, and all of the refis went away. Now, the only one who would be refining right now is someone who's desperate, right? They're desperate for money. They can't afford their payments. They need to get cash. So they're giving up their 3% loan, and they're refining at a higher 4% loan. Now, the only person who would do this are desperate people, and there's a few of them still going on. But my point is that the mortgage industry is starting to collapse. A lot of mortgage companies are starting to lay off their workforce. Some laid off as many as half of their workforce already, because there's no mortgages coming in. Look, there's very few sales going on in the real estate market right now. U.S. pending home sales plunged in January. Okay, and they plunged because the mortgage rates are jumping up. Now, here's what I want you to think about. Let's just take rough numbers. Okay. So in the last year, houses basically went up 20%. Now, I think we're going to get a half off sale. That's my opinion. Now, a lot of people think we're going to have another 20% up year. Zillow, they think they're going to have a 23% up year. Now, of course, Zillow has lost billions of dollars buying houses, so I wouldn't really take their word for it. I think we're going to get that half off sale. But let's just take a look at like a typical home that was $1 million last year. Okay, so the home was selling for $1 million, and now it's $1,200,000. All right, now the mortgage rate went from 3% to 4%. Now, last year, it was $1 million, and it was 3%. This year, it's $1.2 million, and it's 4%. Now, okay, if it was $1 million last year and they were paying 3%, now mortgages, well, real estate people buy with mortgages. That most don't buy with all cash. Sure, there's some of that going on, but most people get a mortgage. Now, okay, so at $1 million at 3%, they were paying $30,000 for the year in interest. Okay, so they got that payment for, $30,000 in interest for the next however many years. That's called 30 years. But they're paying $30,000 a year. All right. Now, right today, that house is now $1,200,000 because it went up 20% year over year. Houses went up 20% that last year. So that $1,000,000 home is now $1,200,000. All right. And now the interest rate went from 3% to 4%. Okay. So we now have $1,200,000 at 4%. Now that's just interest alone is $48,000. Now remember, the same house last year you could have bought with $30,000 as your interest payment for the year, and now it's $48,000 is your interest payment for the year. So your payment basically jumped up about $1,500 a month. Okay, $1,500 a month. Now some people don't have the extra $1,500 a month, so they're priced out of the market. Those buyers went away unless they have the extra money. The affordability factor is just getting crazy right now. And I'm not even taking into account property taxes. Yeah, property taxes are about, let's call where I am, they're 1.2%. Let's just call it 1% on $1,000,000. You know, that's $10,000 a year. Now it's at $1,200,000. That's $12,000 a year. It's just an extra $2,000, which is chump change when you're talking about the $1,000,000 house, right? Okay, so my point is that the affordability factor is really getting out of control. Now, new home inventory, they're having trouble getting new homes sold for several reasons. Well, because the mortgage rate's going higher, but also the cost to build these homes getting higher, so the builders are getting squeezed, right? They can't get them sold, but so they kind of have to reduce the price, so they're not making as much money as they thought they were. Some builders are already taking losses to where they're not making any money. They built this huge house and they're losing money because the mortgage rate went up and nobody can afford to buy the huge house. So the affordability factor is gone, right? So a lot of buyers have just gone away. They're priced out of the market. Now, a lot of people think we have an inventory problem. Now, personally, I don't think we have an inventory problem. I think this is going to correct itself. It's going to correct itself because we got all these foreclosures coming onto the marketplace. That's correct. We have foreclosures coming onto the marketplace. But there's a lot of homes. Just in San Francisco. San Francisco has 40,000 vacant homes. 40,000 vacant homes. But you know what San Francisco is going to do? They're going to put a tax on vacant homes. There's now going to be a vacant home tax. Interesting. Well, okay, so some of these homes might start coming onto the market. We got foreclosures coming onto the market. Who else do we got coming onto the market? We got landlords. Landlords that are tired of not being able to evict their tenant. Now, the eviction moratorium has ended in a lot of places. I think last week, Seattle finally said, okay, you can go ahead and evict tenants. Well, once they get the tenants out, maybe they don't want to be a landlord anymore. So those homes will come on the market for sale. There's a lot of changes going on. Now I talked a little bit about short sales, right? Okay, so now I'm an old guy. I've been around the real estate business for quite a long time. Now, in 2007, 2008, we were doing what was known as short sales. So these were sales, for example, I'll tell you one of my clients, okay, she bought a couple of houses and she made them rental houses. Okay, so she bought them for $400,000 and she thought she was safe because she put $200,000 down on each of those two houses and they were going to be rentals for her. So she put $200,000 down and the house was $400,000. She put $200,000 down. So she still owed $200,000 on each of these houses. Well, the houses dropped to about they dropped below $200,000. It was over a half off sale back then in certain areas. And these were actually in Merced, California is where she bought these, which just plummeted. I mean, it just got hit hard. It went from $400,000 down to about $120,000. Now, okay, so anyways, she owed the bank $200,000 on each one of these. She didn't want them anymore. She's going, I don't want these. So, well, she can't sell them for more than $200,000. So if she sold them for $120,000, she would have had to pay $80,000 more dollars just to get rid of the house. So what did she do? She called up the bank. Well, actually, I did. I said, look, she doesn't have the money. She wants to, she doesn't have the $80,000. So will you take these houses back? So the bank, they have to take the hit, right? They're owed $200,000 on each house. But you know what we ended up selling those for? $105,000 each one of those. The bank took a $95,000 hit on each of those properties because the bank doesn't want them. Look, you give them to the bank and they don't know what to do them. They're not, they're not landlords. They're not real estate agents. They give them to us to sell. But that's a short sale, and short sales are going to be coming back. When the half-off sale happens, a lot of these people that have these mortgages, they're going to be underwater, and they're going to want to give their house back to the bank. Well, what are they going to do? They're going to short sell. Again, it's going to come back and vote because we don't learn anything. Look, here's what's really cracking me up, right? So the affordability factor is hitting these homes. Okay, so the new homes, they can't get a 30-year mortgage and still afford the home. So what are they doing right now? Because they can't afford the 4% mortgages. Well, they're going back to the adjustable rate mortgages, the ARMs, okay, right? So they'll start you off at maybe a 2% rate for the first 6 months, but then it jumps up to 4% after the first 6 months, just so that you can qualify, because you can qualify at the 2% rate, but then what happens after 6 months? Well, it's at 4%. Well, if you can't make the payments, they're going to it's called negative amortization. They're going to attack the amount onto your loan, so your loan keeps going up. Well, they say, don't worry about that. The house will go up. Well, it's great if the house goes up, but what happens if the house goes down? It becomes a big problem, a big mess for the mortgage industry. Mortgage industry is under a lot of pressure right now, and it's going to get worse. It's not going to get better. I'm telling you, it's going to get worse. The real estate market is in big trouble. There's big warning signs. Look, I think the market's changing. That's just my opinion. You could go with Zillow's opinion, and they'll be up 23% higher next year. I say it's going to be lower next year, probably by about 23%. But I do think we're getting to that half-off sale. It takes time to play out. Maybe a year, maybe 2 years, but we're going to get a half-off sale in the real estate market. That's just my opinion. Anyways, I'm Tall Mike. I hope you enjoyed this today. If you did, give me a thumbs up. Get out there. Have a great Wednesday, everybody. We'll talk again real soon. Bye-bye now.